is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com. Now, here's your host, Aaron Kolkman.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. You can check out this weekly economic market roundup both at asv.com. That's astewardsview.com/blog. Again, astewardsview.com/blog. Our mission here is to help you cut through the information chaos of the digital era so you can be wise and decide well. That is, we work hard to bring light to your financial decisions as stewards. Last week, and Chaz, I've named our series here, okay, and I just want to warn you, okay, if you don't like it, that's okay. We can talk about it. This is our investment planning series. It's called Pie Charts with Purpose. Okay?
Wow.
Oh,
Bravo.
You're happy? You're good with that? The pastor in you is coming out and he's celebrating. Okay. So we talked about the universal pie chart last week. That is the benefits of aggregating assets, pulling together all pie charts into one. In case you missed it, you can revisit that episode and others on YouTube now. This is good. This is progress. Spotify, Amazon Music, that is Amazon Music, and Apple's podcasts. Okay. So Chaz, I have to say, last week was one of the most fruitful conversations we've had on ASV since we started this March 3rd, 2025, in my opinion. This week, we want to get more into, okay, now we have this universal pie chart. Let's look at the overall. Let's look at the risk. Let's look at the return. And, oh, yes, asset allocation or location, right, to be clear. Then let's run a correlation analysis. Let's seek low and negatively correlated asset classes first and holdings second. Where in the world are we going to invest? What kinds of holdings should they be? What are the vehicles? What are the fees? So we're going to continue seeking to answer those questions for you, the listener, as we equip you and encourage you in every way we can here every single week. We record this program on Mondays, and it's shared globally every single week. So visit us online at astewardsview.com, and we'll keep answering these important questions for you. So you can engage with us there as well. I encourage you to do that, as well as on our own website and the podcast platforms, now YouTube. So we'll keep marching towards, though, here it is. We're going to march towards asset optimization, the science and the art of building a portfolio with the idea that 1 + 1 can equal 3. And at the end of this series, we're gonna come back to measuring the value of advice. And Chaz, I'll go as far as saying that the things that I'm talking about here are so mission critical for investors, particularly when asset prices are high, like they are right now. When we've had a big run up, a major bull market in 3 years' time that has set records from 2023 to 2024. This happens. We had a big bull market in 2022. Or bear market, for 6 months at the beginning of that year in 2022, a 50-year event. I don't know if you realize that. It was the first time in 50 years in 2022 that we had stocks and bonds both down for 2 straight quarters at the beginning of the year. Okay, it was a very difficult time for investors. So we've had this huge run-up since then. Okay, so the things we're talking about here, managing risk, all the more important, right? Looking at the overall, all the more important. Looking at the costs, all the more important. So we're going to keep going, but we're going to land on what does it look like to measure all this? Okay. And I submit respectfully to my colleagues in this really amazing industry, some incredibly bright and capable people that I meet and interact with, that there is a way for us to measure the value of advice. We may not want to look at it on either side of the table, but there's a way to do it, and we're going to get to that. So before we begin more in this series, I do know that a few weeks ago we talked and we were into the topic, and I try to do this early on in our episodes where we have a moment to look at God's word and the context that we're working from in the light of eternity. So we're making decisions or talking about decisions in that light. Okay, so let's just look for a moment here, like we did a few weeks ago, about the fruit, the heavenly fruit, the spiritual fruit called peace. And I mean that as Jesus's kind of peace. Okay, it's an important ingredient for good stewardship and a commonly recognized marketing concept around money, I might add. So we hear Jesus in the Gospel of John, chapter 16, verse 33, and he's having this conversation with his disciples, and he says, "I've said these things to you, that in me you may have peace. In the world you will have tribulation. But take heart, I have overcome the world." We hear the Apostle Paul say in Colossians 3, verse 15, "And let the peace of Christ rule in your hearts, to which indeed you were called in one body, and be thankful." If we were to read more of Jesus's comments about peace, or we would find out that he really is distinguishing between the peace offered by the world, and so is the Apostle Paul. We can distinguish between the world's peace then and Jesus's peace. Likewise, between peace in human terms and that in God terms. It's divinely granted. So divine peace, if that's what we're after here, okay, it extends to all areas of life, right? I've talked about in this program how, Aaron's growing in this too, right? So right there with you. And it's a blessing. It's one I'm grateful for in God's word, Chaz and others. We'll post a reference from Crossway on our weekly blog this week for you, the listener, to consider relating to this important fruit of the Spirit, okay, and how we approach our decisions, all decisions, not just financial ones, okay? But with that kind of peace in mind, let's get further into the details of leveraging our pie chart with purpose, okay? So last week we accomplished, I hope, a singular pie chart, the universal one, I called it. Now we can see that big picture, okay? And we can accomplish, I'm going to say three things. We can get historical risk, historical return, and historical correlation. Okay, so we're not going to unpack all those. We're going to touch on all those in this particular episode. And remember that anytime we talk about risk or return on this program, we're actually talking in historical terms because that's what we know. We don't know the future. We know something about the present from what's going on around us, but we really only have clarity about the past. And that's why all the disclosures come out. That's why we say, okay, not a guarantee of the future. Nope. So let's just keep that in mind. But we'll look at historical risk, historical return, and historical correlation in this episode. And we can start to answer those important questions. Where are we going to invest? What kinds of holdings are we going to invest in? What are the vehicles? What are the costs? And we'll keep going on to asset optimization. So before we go there, let's take a quick break, and we'll also check out our noise segment.
Investors have holdings scattered under multiple logins. Now there's one place to put it all together. Your entire portfolio in one place. Every asset house, every holding, every transaction, every day. It's called Fusion. Fusion means ongoing portfolio aggregation, without a contract and without a hitch. This important tool can put all your investments into a single view with a universal login, provided by Morningstar and sponsored by Fideer Advisors. Fusion gives its users the benefit of a constant monitor and quarterly risk-reward reports on the entire portfolio. So take a break and take advantage of this valuable view. Register now at FideerAdvice.com. Just click Fusion at the top of the page or type in FideerAdvice.com/Fusion. And now back to A Steward's View.
Okay, Chaz, so I'm assuming that you have another really interesting noise segment for us today, or is that just my assumption?
Oh, no. We got something for you, bud. I got you handled. We're going to go back. I think our very first week we had this this gentleman. I can't remember his name, but it's a guy. I think maybe his name is Steve. I could be wrong, but he is an Asian American guy, and he used to be a school teacher, and now he does his whole thing is investments, and he he has these really short, thoughtful reels. And today, this one is going to be called 3 Ways to Protect Your Money When Rates Drop. And so we're just going to see what your thoughts are. If this is, I always tell people, there's lots of stuff online, lots of mixed motivations online about any number of things, from God's word to investments. And, a lot of it's true, but it's chew up the meat, spit out the bones. We'll see how this matches up with your thoughts, Aaron.
We'll have fun.
This is good stuff. So here, give me 1 second here, and I'll pull this right up. Here it is.
Interest rates are about to drop again, and these are the 3 things you want to immediately do to protect your money. My name's Steve. I'm a former public school teacher now teaching money lessons that I wish I taught my students. 1, the interest rates for your high yield savings accounts are about to drop. And one way to lock in rates is to put some of that money into certificate of deposits, or CDs. Even though the Federal Reserve drops interest rates, the interest rates for your CDs don't drop for the next couple of months, depending on which one you choose. These are my favorite high yield savings and CDs at the moment with competitive rates, or you can go to my bio to see my full updated list. 2, pay off your credit card bills every month. A lot of your financially illiterate friends will persuade you to spend more money on your credit cards because of the lower rates. Don't do it. There's a reason why they're broke. 3, you want to start investing. The wealth gap gets wider every year, where the rich get richer and the poor get poorer. The stock market generally likes to go up in a low interest environment. And if you want to ride the wave up like all rich people, you have to finally get financially literate and own assets. These are the brokerages to choose. I personally use Schwab and Fidelity. These are the brokerage accounts to open up. I like Roth IRAs and taxable brokerage accounts because they're the easiest for beginners. And these are my favorite low-cost index funds because I like to keep things simple. Because if you max out your Roth IRA for the next 30 years, you'll have around $1.1 million with average returns, where you only put in $200,000 of your own money. Let that sink in. If you want to start investing, these are my favorite books and websites to learn from, or Common Blueprints if you want to join my one-on-one investing coaching program to help you get started. And if this video helped in any way, like and follow so we can grow our finances together this year.
Okay, Aaron. There's a lot. There's actually a lot in there.
Very convincing stuff. Do you remember last week when we talked about, hey, there's going to be all this noise about good things that have happened recently, right? Because we've been in this long cycle of upward moving asset prices. Okay, so there's a lot there. I'd actually like to spend the rest of our episode on that. Maybe we'll do an ASV plus on that. I've been referencing ASV plus for a while, but here it is. And I want to correct something that I said last week, by the way, because in our noise segment last week, I got listening to this. When we talk, there was an option that you gave me between currency prices, or the dollar recovering and treasuries running. Okay,
right, something like that, yeah.
So in my head, this is just Aaron's brain. When you put currency prices and treasuries together, I start thinking about treasury yields.
Sure.
Okay, I don't think about treasury prices. So I'm not.
Man.
Hold on. No. But the two yields and prices move opposite of each other in treasuries.
Right.
Okay.
Right.
So what I said, I'm going to correct here, and that is that something like that. That's not the way it works with treasuries. That's not the way it works with treasury yields. Is what I needed to say a week ago, relative to what the idea that rates going lower wouldn't cause a run with treasuries. Okay, it would cause a run with treasuries as to prices, not to yields. Okay, so what he's saying as it relates to interest rates, remember that there are two ends of the interest rate spectrum that he's not talking about, right? There's the part that the Fed controls directly and the part that they influence indirectly. The part that they control, most bank CDs aren't based on that. Okay, they're based on the part that the Fed influences. So that's automatically just, what's the word? He's pontificating, I guess. Sure. So I would just caution anybody on that point alone. I mean, when we look at what is the 5-year treasury and the 10-year treasury doing, that's what generally banks are putting their offers out from. They're not putting it out from what is the rate on cash that we have to pay in a checking account. Okay, that's the that's M1, that's the Fed funds rate. That's what banks borrow from each other at, right? And then they don't pay much on that to the average depositor coming in. So yeah, if you want to go out a little ways, you can go out and buy bonds. You can go out to any of the brokerages he mentioned. Another issue I take, and this is not to pick on him, by the way. This is to say, to kind of get the record really straight, that the asset house, I mean, he's trying to get some name recognition there. That's fine. Oh, I work with Schwab, I work with Fidelity, whatever. No problem. But as soon as you start to say, well, Roth IRA, traditional IRA, these kinds of account types, those may or may not be good account types for somebody. Okay. I mean, I'm setting up a Roth IRA for somebody right now who's going to put a little over $300,000 out of his traditional IRA, hopefully, if he follows through with it, soon this year, out of his traditional IRA into his Roth IRA. Okay, he's 62 years old. He's never had a Roth IRA, right? It's actually been counter to his tax plan to have one. So he has a reason to have one now to do these Roth conversions because his earned income is lower. But I digress. The point is to say, oh, well, these are account types. No. They're tax treatment of the same account. So what is the tax treatment that you want on a brokerage account is a planning question. It's not an investing question. Okay. So I'm just really glad we brought that up. But yeah, it seems like a capable person that's making a lot of noise. The other thing I want to mention, I talked about history. All we have is history to go on when we talk about investing. And when I hear somebody say this will happen, I've seen some way less forward-looking statements get pulled off the air really fast and people delicensed really fast for saying things like that. I would just run in the other direction if I were anybody listening to anybody. Again, not to pick on him, but to say, when you hear statements like this will happen, that's automatically just cause for concern because you have no idea what's going to happen. I'm arguing for a correction in our major indexes in the U.S. and developed countries in general in the next 2 quarters. Okay. And I could be wrong, but we're not going to go without a correction of some kind soon. And why do I say that? Well, I mean, what goes up must be moderated when it goes up really, really high for a long time, right? That was 2022. That was 2018. That was 2008, 2001, and 2002. So we're having a very frank and planning driven conversation on this program by design. But I see how people get caught in that and they get excited. It's very convincing. I just have a lot of caution to throw. So those are my thoughts. You gave me an open mic and I took it.
Well, they were very good, man. Let's get back to our regular program.
All right, let's go. All right, and we're back. So we talked last week about the universal pie chart, and what we didn't really get into is what to do once we have it. We talked about the benefits of it. So I'm going to post later today when we do our economic and market roundup and post that on astewardsview.com on the blog. I'll also post an example of what it looks like to have a universal pie chart, and it'll be a case study that just shows here's the risk score on the overall across multiple accounts. Here's the return score on the overall across multiple accounts. And then this thing that we've talked about briefly this year called the Sharpe ratio. Here's the Sharpe ratio on the overall. Okay. And pretty soon we're going to get into modeling, not to put everyone to sleep, but to give examples of what it's like. And I'll put a reference out there today as well, what it's like to have a more optimal set of risk, return, and Sharpe. And what is Sharpe? Okay. This Nobel Peace Prize winner, Stanford emeritus professor in finance, brilliant man, William Sharpe, basically put together a formula and said, hey, for the risk taken, how much excess return did you get? Okay. So that's another way of saying how much does 1 + 1 = 3 really? Right. Okay. And that's just, vernacular from me. It's not actual math, but we'll look at those. Okay. We'll give you that example. That's the first thing you can do when you get asset aggregation done is you can start to have those scores. So when you've got those scores, then you have to compare it to something, right? And there's actually 2 things that we're going to compare against, one of which will show up in that same example that I post tonight. And that is the marketplace itself, right? So when you say, okay, I've got a risk score of 15, I've got a return score of 15, that means that my average return backward looking and whatever time period that was, backward looking, not forward, right? It says 3 years, right? We get a 3-year backward looking risk and return score of 15 and 15. That means that if I take my average return of 15, which would be amazing, but lately realistic, and I add the risk score to it or subtract the risk score to it from it, we have a range there of 0 to 30. Okay, so during that period of time, I could expect to have had somewhere an actual return, because remember, we're reporting averages, right? That's not what you actually got across all of your accounts, right? You don't line up all your accounts and get 15% in every account in the last 3 years. Or maybe you did, Chaz, but I don't know anyone that did. Okay. So, if I could do that, I joke I'd have a, building full of people waiting to talk to me. But the idea is you have these data points around those averages, risk and return both. You don't know what they are. You aggregate, find out, and then you go, okay, well, it looks like during this period of time, I've got somewhere between 0 and 30% in this example is what I would have expected to receive or could have expected to have received during that period. So what then? Well, going forward, we just got done saying that it's going to be a little different pattern to expect for investors. I mean, how much more can the AI boom go as far as capitalizing it? Not very far in my view, but whether we have a correction next week or next year, to say we're going to have another 2023 to 2025 is just not very realistic. Okay. Historically, just stocks on their own, which most people are not 100% in stock, they generate 10 to 12% per year. Okay. In the US. So, having said all that, what we can do with this is we can then say, all right, well, what's realistic? Maybe we get a 5-year view. Maybe we get a 10-year view. Maybe that's more like a range of returns between -5 and 20. Okay. So what? Well, when we compare that to the marketplace and we say, oh, well, the marketplace is similar, but not exactly the same. It won't be the same. The Sharpe ratio is different. Okay, that's our ultimate measure in this part of the analysis. But what we can do is we can say, well, is there a way for me compared to the market to improve somewhere? And we can look at the risk piece and we can look at the return piece and we can do that. Okay, and that's why I'm so passionate about this process, because when we start to say, well, I can reduce risk or I can reduce return, historically speaking, and shrink we're only just expecting upon the future from the past, right? That's the the ground that we're on, but we can expect or realistically expect to have something like the long-term numbers that we've seen from what we're already doing, what the market's already done. And I'm moving away from a 3-year in that example to a 5 or a 10. And then we could say, all right, well, what are the things that are causing this risk score? What are the things that are causing this return score? And we could start to look at those. Okay. And I keep coming back to correlation a little bit. I want to try to touch on that again in this episode. But knowing where your Sharpe ratio is better just by itself, but compared to the market is super important if you're going to go through this process. Because if it's two different things to say, well, I got a better Sharpe ratio because my risk was lower. And I got a better Sharpe ratio because my return was better. Okay. Both are possible, right? So which is it? All right. So, and by the way, what kind of investor are you? We haven't talked about that in this series yet. I've said a lot, 90% of the investing public that I've interacted with in 25 years are not aggressive investors. They're not equity only people, right? This is single generation wealth. Typically, we're trying to build it. We're trying to preserve it as we go in pieces. And that's why you don't have 100% in equity. As much as I like that, as cool as it is to talk about. So that comparison of risk and return overall across all accounts, whatever tax treatments, Mr. So-and-so on the noise segment, compared to the market's version of that, that's our first comparison, okay? So there's multiple points of comparison, multiple timelines in that. The second point of comparison is where modeling comes in. And that's I believe, why the Fusion program is so important and why my firm is still in business. The sponsor of this program is Fideer Advisors, and we spend a lot of time trying to bring good covariance from where in the world we invest, and from not the holdings even, but where we invest, how those holdings interact with each other, right? Lessening friction, increasing harmony, okay? And looking at that as kind of an ideal picture of what we want to accomplish. Okay, and I'll make a reference right now. If you go visit to thedeeradvice.com/models, you'll see aggregate models that are updated once a year, and we're showing. And I'll encourage any industry participants, any professionals listening to this program, to do the same thing. Show your holdings. I don't care if they're separately managed accounts or mutual funds or ETFs or what you're doing. I don't care if they're composites or hypothetical. These are examples. So hypothetical. Will I have composites someday? I think so. Hopefully. Haven't needed to for the families that we serve so far, but at some point, I think that'd be great. Okay. And that's important from a reporting standpoint and beyond the scope of this conversation. What I want to say here is that it's important to know at the end of the day, what is it that we actually built? Okay. So to come on a program like this, Chaz, and I'm just going to say this because we're there, and say, oh, well, I've got these great ideas. I talked about that last week. Everybody's got great ideas. Okay. I almost don't want to hear any more ideas. I want to know, how did you line up? How does it compare to ideal? And is it funding your goals? That's it. Okay. And if it's causing you to not sleep at night, or you've got something really broken, absolutely, you should look at it. But to say, well, I've got the latest idea, flavor of the month, do you really? So I'll stop there. Go ahead.
Brother, you're talking about great ideas and how you sleeping at night. To thread it back to the beginning, you were talking about peace in the Bible. And I got to go Pastor Chaz for a minute.
Come on.
One of the greetings, it's a more formal greeting with somebody in Hebrew it's really, really cool. It's Ma Shalom Cha. Okay. I'm probably saying that wrong because I'm a Latino, definitely not a Hebrew. But really what that translates to is, it'd be like, how's it going? But it'd be with somebody that you know and care about. What the literal translation of that is, how's your peace? That's that word shalom that appears throughout the Bible again and again. And back to the flood, God sends the olive branch. Think about what we say, oh, I'm going to extend you an olive branch. What's that? I'm going to make amends. I'm trying to make peace between us. And that's a theme throughout the whole Bible, is God extending peace. That famous verse from Jeremiah 29:11 that you referenced briefly says, for I know the plans I have for you, declares the Lord, plans not to harm you, but to prosper you, to give you hope in a future. If you read that in some literal translations as plans for wholeness or wellness, that's again that idea of shalom. So if you're having trouble sleeping at night, the word here from the Lord, I say from Aaron, is Ma Shalom Cha. How's your peace?
Love it.
Love it. Listen to a little bit more of a steward's view. Be wise, decide well, and you'll have a little bit more of shalom in your life.
Amen. Chaz, I couldn't have said it better. I'm so grateful for that word. And I'll tell you, the challenge, and this is why cutting out noise is so important, and having measurements, having regular, yes, you want to review with whoever you work with. That's important, but a consistent set of measurements that you follow for how things are going on a rolling multi-year basis, right? That's the key to long-term, human peace about what you're doing, but to get you closer to the kind of peace that you're talking about, right?
Yeah.
So, to hopefully help you.
Well, the synonym,
we need God's help ultimately.
That's right. The synonym we use for peace, it really there is this idea is wholeness. And when you think about what you do on the air compared to the noise that we're going to keep doing because it's just too fun to hear what people are kind of ruminating on, is this idea of completeness. It's not just stocks. It's not just bonds. It's not ETFs. It's the whole picture. It's the strategic picture, not like you said, a product, but this is a strategy. So,
amen. And so with that, let's just do one more thing together. And I'll run this tonight as well and put it up in that same example I mentioned in this investment planning series. And that'll be a correlation analysis. But before we get to that, let me just add that when you model the areas of the market that you want to invest in, the kinds of holdings you want to have, the costs of those holdings, all the pieces of good investment planning together, it is anecdotal, but you can start to see where can I refine, where can I, historically speaking, dial down risk and perhaps improve on my return, or both. And how does that compare to the marketplace? Okay. And when we do that, now I've got two comparisons. I've got my current set of holdings compared to a relevant marketplace comparison. Okay. And at Fidere, at my firm, we use a global analysis because the more we spread out geographically, the more opportunity we have to find things that aren't correlated together. They don't move together, right? They offset and complement each other in terms of risk and return. So the point there is to say that's one comparison. The other comparison is when this is right into asset optimization. How do we take what is, and I'll draw this out next time right on the program because we've got that option, but we're going to draw out the capital market line and we're going to take the portfolio return and we're going to subtract the capital market line from it. And we're going to come up with a score. And that score, that is my, optimization score or my mean variance analysis score, if you want to call it that. But we're going to find out, did I do better than the marketplace really in terms of covariance, in terms of correlation? Okay. Not in terms of just return, not compared to my, it's not any one piece of this comparison. It's a complete summary comparison, if you will, of how did I do relative to what? To a exactly the risk and exactly the return that the market offered, but not a Sharpe ratio. Okay, so think of it as an asset allocation, diversification, optimization score. Okay, so if we can do that together, we can get there, we can use that. I would say to you that, and this is going to fly in the face of some regular advice givers, you will be able to tell whether or not what you're getting as an investor in any advisory relationship is worth it. And I'll tell you this, Chaz, what I just said is not popular. And it's the reason that this conversation isn't more widely had. But we're going to have it. We're going to get there. I'm looking forward to it. And I think it's really going to be good on multiple levels. So I look forward to that next week. Look for those examples tonight out at astewardsview.com/blog, in addition to our economic and market update. So with that, we've gone through a lot here, Chaz. I don't want to belabor these points any further unless you have something else you want to add.
No, brother, I think it's time to wrap.
Okay, well, I hope this session has been a blessing to you and others you decide to share it with. Next week, we'll go further into our investment planning series, and we're going to talk specifically about scoring optimization and how we know if the value of advice that we got was worth it or not. Okay, so we'll get right into that hard work next week, and I look forward to that and bringing clarity to your financial decisions. That's what this is all about. So in the meantime, visit us online. From all of us at ASV, we look forward to connecting with you soon again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.